But let me now welcome on board the management of Federal Bank. Let's talk about what the implications, if at all a rate cut comes by here, what that could be, and what are really the concerns and the positives right now for the banking sector and, of course, Federal Bank per se. Harsh Dugar, the Executive Director at Federal Bank, joins in on the show right now. Harsh, hi, morning. It's so good to have you today on ET Now. And, I want to first begin by asking about all the concerns around deposit growth. Break the myth for us, because pretty much all regulators and everyone sort of raised the red flag. What is the situation with you at Federal Bank?
Good morning and thanks, Aisha. Yeah, the deposit growth, I think, has been talked about quite a bit in the last 12 months or 18 months now. And obviously, that deposit growth, if you look at it, has been hovering somewhere around 11%. And the advances growth has actually picked up post-pandemic to at about 14%. So what has happened is the CD ratio has moved, which was at around 75%, closer to 80% levels. Now, definitely, there is a pressure on the deposit growth, but I don't see too much of a challenge going forward because there are steps which are being taken by banks to attract deposits back to the system, obviously by offering better pricing. And in fact, in the last RBI meeting also, they were talking about innovative products being bought by banks also. So is the challenge real? Answer is yes, won't deny that part. And what is adding to that is the likely impact if the draft circular on LCR goes on, that will have a further impact on the liquidity available banks to lend. So what will happen is probably, yes, banks are targeting for deposit growth and also looking at moderating advances growth because you need to fund the assets. So this is where the issues are. But I don't feel that the challenge is so acute. It is definitely an issue, but not so acute, which cannot be managed.
At the realistic scenario, which is that interest rates or fixed deposit rates are unlikely to go higher, right? Interest rates globally, if they come down, interest rates in India will also come down. I'm only talking about fixed deposits here, Harsh, right? If that is the situation, then liability which currently, or bank deposits which currently are already fighting with SIPs and with insurance and with REITs, it will make them less attractive. So this entire war of liability will only in a sense multiply.
I would agree with that part. See, there are always cycles when people will look at investing a portion of their funds in equities, a portion of their fund in fixed income, a portion of their funds with fixed deposits. So that part will be there. And when a rate cut happens, the bonds and other fixed income securities will also come up. So that's something which is evident, whether it's GSEC, whether it's corporate bonds, or whether it's fixed deposits. And that's something we are bracing for. Stock markets typically has, if you look at the last 3-4 years, the run-up has been phenomenal. But if you look at a longer trend, it is a different class of asset which is targeted by the youngsters. And when they burn their hands, what I'm saying, I'm not saying that they should burn their hands for sure, but they do look at fixed deposits. So when people look at a portfolio allocation, they look at a fixed income as well and not just equities. Answer is yes, equities at this point of time looks attractive, but people are also talking about markets being overheated. And if that be the case, the money can come back again to the banking system. That's one part. The second part is even when people invest in stock markets or SIPs, the money remains in the banking system. It's not that the money is going out. The money technically goes out only in 3 instances. One, if the money of the government with RBI or currency in circulation, or if money goes overseas. So to that extent, the system which we are expecting and the deposit growth is in about a 12 to 13% range, which according to me is reasonably adequate to fund the advances growth also. I'm not saying it's not a challenge. Don't get me wrong on that part. It's a challenge, but I'm saying is it's not so much of an issue that it cannot be managed.
Fair point. Now, in the light of where interest rates could move and where liquidity could move, now whether rates come down first or liquidity increases, we don't know. That only RBI knows. But they both are going to move in tandem with each other. So if liquidity eases, what happens to your spreads and what happens to your credit growth?
I'll address 2 parts. One is the liquidity part and the other is the cost and the NIM part of it. Now, if you look at the liquidity at this point of time, the liquidity looks like improving because the balances the government has been having with RBI, which had gone up to as high as 5 lakh crores, is about 2.5 lakh crores right now. This liquidity, if it comes back to the banking system with the money multiplier, it helps and aids in terms of advances growth. So that is one part of it. So if you are looking at liquidity, I do expect liquidity to ease a little bit by steps taken by both the government and the RBI is happening. The other part is regarding the NIM. Now, there will be, see, the question of a rate cut is a matter of not whether it will happen or not happen. It's a question of how much and how soon. So this is something which we are definitely looking at. And according to me, when the rate cut starts happening, the pricing cut for the advances will lead the cost of funds coming down, which is what happened when the repo went up. So the advances rates went up faster than the cost of deposit. So will the banks face pressure on NIMs because the yield on advances is likely to fall faster because a large part of the portfolio of the banks, about 40 to 50%, is linked to repo because of RBI's mandate of MSME loans and retail loans being linked to repo. So that is likely to come down faster, and deposit cost will come down, but with a lag.
Okay. Now, specifically for Federal Bank, the growth has been 20% plus. Specifically for Federal Bank, they've been managed to garner a lot of deposits through their brand and through their expansion. So can I say that irrespective of what macros we are discussing, whether it is liability or whether it is liquidity, you are reasonably confident of growing your CASA and your credit growth rate at historical rates of higher than the industry average, what you've demonstrated in last 3-4 quarters?
Most certainly, Rikuj. We look at, and we've been guiding the market saying that we will definitely grow at higher than the industry average would be. And if you look at our performance in the last several quarters, we have been gaining market share by a couple of basis points, 1 or 2 basis points every quarter. And we are reasonably confident of achieving that part. And it's obviously a mix of quite a few things which is being done. Part has been a branch expansion, which we have been doing the last 2 years. The second is obviously using our distribution channels that much more intensely. CASA has been a challenge, not just for us, but for the industry as a whole. And we're looking at multiple products to do it because CASA, unlike advances growth, is not something you can solicit. CASA comes to you because you have multiple products sold to the client customer. So that's what we're looking at. We're looking to increase the product per customer, whether it's a corporate or the retail customer. And that in turn will aid us in terms of CASA growth.
Next, another topic which everybody is now discussing is that in the overall scheme of things, how exactly could the fintech lending be impacting especially some of the unsecured categories? Fintechs are following, schemes where you buy today and you pay later. What is it called? BLPL, right?
BLPL, buy now, pay later.
Yeah, buy now, pay later. These are disruptives. I've never used it actually. Have you ever used it?
No, I've personally not used it, but there's a younger generation or a lot which definitely does use it.
So everything, all the youngsters have iPhones, Nikunj.
No,
it's totally on that.
But Aisha, this is where RBI is saying that guys, hold on to your horses. There is a risk. Yeah. Your in hand is 10,000 and the loan which you're taking to the unsecured category is 50,000. How will you pay it up? So buy now is great. Instant gratification.
But
pay later is who pays later.
Yeah, that's the concern.
How do you see this risk profile for unsecured category moving?
The RBI has been cautioning banks about the risks and challenges related to unsecured lending. While we do feel that the risks are a little bit heightened, it's again not an area of should panic. If you look at the unsecured portfolio for the banking system as a whole, is not a significant percentage of the lending. Now, I'll address this in two parts. The banks lending unsecured to consumers directly, and the banks lending to NBFC, who in turn lend to the unsecured loan. Both are slowing down, partly because banks and NBFC both are looking at tightening the norms for doing so. That's number one. It will definitely have an impact on discretionary spending by consumers, because what was becoming an impulsive purchase because you go to a store, you like the phone and you know that you have access to, you have to only pay a nominal amount, and the iPhone, as Aisha was mentioning, is yours, is less likely to come down as banks tighten. Maybe they'll increase the threshold levels, but that is definitely in the cards and it's evident. The slippages, what we expect this year, will probably be marginally higher for the industry as a whole on this segment. And let me assure you that the players in the market, whether it's NBFC or banks, are quite cognizant to that. Now, when you bring fintech into the situation, fintech is only an additional tool available to make access to credit more convenient to the consumer. It really doesn't change because the business rule engine is that of the bank. The credit filters are that of the bank. So that's not something which they can change. It only adds the convenience value for the customers and probably a better distribution and a better reach because they reach out to customers as well for the banks. So this is where it is. So what RBI has been coming down are two things. One is cautioning banks regarding lending to the unsecured segment. The second is that when we are dealing with fintechs, RBI is very clear about a few points about data security, data privacy, about cyber security, and also of consumer protection, which basically means that there should not be unfair practices to attract customers. So they have issued a lot of guidelines and they want to ensure that there is no regulatory arbitrage being done by fintechs because they are not the governed entities. And hence RBI is ensuring through banks and NBFCs that the norms being followed by fintechs adhere to these broad principles.
Also, Morning, get in a sense from you as to what the outlook is, given that the cost of income from the bank was a bit elevated, and during the last conversation, it was suggested that it could come down to around 50%. Do you think that we will see the cost easing in the coming quarter? You also spoke about growing your branches, an aspiration of 100 this year. What is the update?
So the cost to income definitely, there's only one way to trend and that's downwards. That much we can assure you. There are a couple of ways which we are looking at doing that part. One part is on an increasing base. The cost, because the fixed cost gets distributed over a larger base, is one area. Second area is we are looking at giving it a very hard look. One is the employee cost. The other is the other cost. So we are looking at both of them in a very close manner and looking at every possible way of cutting it down. So these are the second point. Third, we are also looking at increasing our share of the high margin products. And you would have seen an uptick, while it is still not a very substantial one, but the trend is sharp and moving upward. So between high margin products, between a larger base and a very hard look on cost, I don't see any reason why it should not. And we are definitely looking at trending it downwards over the next 12 to 18 months. You would see that easing off.
Okay, appreciate your time. Thank you so much for giving us those targets as well as the outlook and what exactly the view is when it comes to Federal Bank. That's a quick take coming in, talking about the implications of the upcoming rate cycle as well as financial parameters.
If you like this video, then like, share and subscribe to ET Now.